Hello, this is Rob from Maverick Trading. Very nice to see you here. In this session, we're going to be discussing a question I've been getting a lot lately from friends and family and some other traders about inflation, about the central banks and what they've done, and really what they are going to be doing in the future to get us out of it. So to really start this whole story off, we have to go back to March and February of 2020, and we all know what happened right around that time. COVID hit. We were all there. We all lived through it. We all saw the empty shelves at the stores, and we all had the same concerns and worries. This was a new virus. We really had no idea what was going on. We had just seen it overwhelm the city of Wuhan in China, and we'd also seen it overwhelm some of the cities in Italy. And we just didn't know what was going on. And so we had government shutdowns, we had stay-at-home orders, and it was just a really crazy thing to have happen. And the effects of a shutdown, the effects of economic activity basically screeching to a halt was rough. And if we take a look at just the effects here we have China, which was the first country hit. GDP down by 6.8%. That is a huge decrease. We take a look at what happened with jobs. 20.5 million jobs were lost in 1 month, as unemployment goes up to 14%. The stock market absolutely fell apart, down 23%. The worst first quarter ever. So we had this period of time where things were looking very, very dire. And the economy and the stock market were in the emergency room. And we thought that, who is going to save this? Who is going to come in here and save this? Well, in steps the Federal Reserve and central banks. And they say, you know what? We're going to try to help. The Fed has a few levers that they can pull. The first lever that they can pull is to manipulate interest rates. And so that's what they did. Right off the bat, they slashed interest rates. And the US took rates all the way down to 0% very quickly. All the other countries around the world, they did the same thing. They slashed rates. Take a look at Europe. Europe went negative rates, meaning if you wanted to save your money, you had to pay them money to keep it in a savings account and a CD. It was just absolutely unprecedented. So the central banks around the world, they cut interest rates down to 0 to stimulate the economy, because with lower interest rates, people are more encouraged to buy things. But here's the problem. Low interest rates don't really help if you don't have a job. And what happened was a lot of people lost their jobs. And this article says 39% of people earning less than $40,000 lost their job. We had 30 million job losses just in May. It's just crazy. And so what happened was the governments, they had to step in to do something. They had to step in and do something. The Fed had already slashed interest rates. It wasn't enough. So they had to move on to their next lever that they can pull. And the next lever they can pull is the money supply. And that's exactly what they did. Whenever you hear about a central bank messing with the money supply, this is something called quantitative easing. Now, you've likely heard about quantitative easing. Let's cover exactly what quantitative easing is. Whenever a government wants to create more money than they have in tax revenue, they create what's called a bond. And the bond is sold out into the public typically. And it is a note that says that the government will pay you a certain amount of interest. And then at the end of the term, it'll pay you the money that you lent the government back. In special situations like the one we had in COVID, the central bank can step in and be the buyer of those bonds. And that's exactly what they do, is they come in and they create money, which they're allowed to do. They're allowed to increase the money supply. And then they take that money and they buy the bonds from the government. The money from the Fed goes straight into the government coffers for the government to use. Now remember, this is a bond, so there must be an interest payment. The federal government must pay interest to the central bank. who then takes that money and turns around and buys more bonds from the government. As you can see, this is money in one pocket simply going into the other pocket. That's quantitative easing in a nutshell. In the United States, we had 3 stimulus packages. The first one for $2 trillion, the second one for about 1.5, and the third one for 1.5. So both of our presidents, President Trump and President Biden, they opened up the floodgates of quantitative easing to a total of $5 trillion. $5 trillion. These numbers, they don't even make any sense. Let's talk about that stimulus. The government sent that money out. They paid, again, PPP loans. They bailed people out. They paid unemployment. They did everything. That money has to go somewhere. It has to go somewhere. So there's 3 things that you can do with money. You can spend it, you can pay back money that you borrowed in the past, or you can save it. So let's talk about spending it. Did the public spend the stimulus money? Well, here is a chart of retail sales. And you can see here that it's pretty much followed a long-term average here. Then up here we got into, okay, this is an issue. We got the stimulus. You can see an initial spike, but it came right back down to basically normal. And in 2021, we actually are trending a little bit above normal. And it looks like to a tune of about, let's call it $7 billion each month. Okay, let's talk about $7 billion and $5 trillion. Look, I can't wrap my head around that either, but that is a fraction. So where did that $5 trillion go? Yes, some of it went into people buying things. Absolutely. We've seen people buying new cars. Car prices have gone up. We've seen shortages on things like computers. There's no question that a little bit of the money went into retail sales. Well, the other thing you can do is you can pay off debt. Did the consumer use this extra money to pay off debt? And you can see, yes, we actually did pay down some debt. As you can see here, this debt curve was pretty steady, and then it actually flattened out. Yes, people didn't go into as much debt. Once they got the stimulus money, they paid down some debt, and it's really coming right back into the normal area. So yes, some money went to pay off debt. The last thing you can do is save your money. Now let's talk about saving your money. Yes, you can put it in a checking account. You can put it under your mattress. Most people don't do that. Most people put it into investments. So let's take a look and see, okay, did the money go into investments? The first thing let's take a look at is housing. Did that stimulus money find its way into housing? Let's take a look at a couple of reports here. Here is the historical trend of housing activity over the past 16 years. As you can see, we skyrocketed. We skyrocketed once COVID hit. We had a huge steep curve here where we are now at all-time highs of housing activity. There is no doubt that money found its way into housing. U.S. homebuilder sentiment reached a record high. After plunging directly after the pandemic, it spiked to a new high. And house prices, we all know what's happened to house prices. It's gone parabolic, and house prices up 19% a year. There's no question that a lot of money found its way into real estate. Let's take a look at the financial markets. Did money find its way into the stock market? Well, we just simply need to look at the averages to answer that question. Here is the S&P. The S&P 500 gained 119% over an 18-month period. It typically doesn't do that in a decade. It did it in 18 months. Money was flowing into investments. And the only way a stock can go up is if there's more buyers and sellers. And what happened was we had a huge surge of new money going into the stock market. So this is the S&P, but really where the big surges were the more speculative things. This is the Qs, this is the NASDAQ 100, and you can see it went up even more. Even more speculative, this is an ETF called the Cathie Wood's ARK Innovation Fund. This was investing in the riskiest and the most speculative stocks out there that were growing very quickly. It went up 400%. When you take a look at stocks in financial markets, they were absolutely beneficiaries of this financial stimulus. Let's take a look at another marketplace. Let's take a look at crypto. Did money find its way into crypto? Well, take a look at Bitcoin, up 1,400%. Take a look at Ethereum, up 2,200%. And of course, we can't forget about our fun little cryptocurrencies, Dogecoin and Shiba Inu. They had huge runs. And so when you take a look at all of these financial assets, they all went up substantially. And we all know what that is called. When financial assets go up way more than economic activity, it has a name. The money had to go somewhere. Some went into the economy and retail sales. There's no question about it. Some went to pay off debt. But the vast majority of that capital found its way into financial assets. That's where most of the money went. It's no surprise to me that we've seen a big spike in prices in the financial markets. This is the very famous quantitative theory of money. Now, the quantitative theory of money is a formula. This equals this. Again, it's a formula. So whenever you have that equal sign, whatever you do on the left side is going to affect the right side. And whatever you do on the right side is going to affect the left side. It's an equation. So let's take a look at what the quantitative theory of money says. M plus V equals P plus T. Let's talk about M. M is the money supply. So the money supply is how much money is out there in the public for the public to use. V stands for velocity. How often is the public using that currency? How many times does that dollar change hands? That's on the left side. On the right side, we have price, basically the prices people pay for everything, plus T, total goods. This is the productivity of an economy and how much it produces. The quantitative theory of money says whatever you do to the left will have an effect on the things and prices to the right. There's no way that we could have had anything other than inflation when we increase the money supply. It's just an equation. It has to happen. Now that inflation is sky high, the Fed has to put on the brakes. So let's go back to the levers that they can pull. Interest rates. What are they going to do with interest rates? Well, they've already told us they're going to raise interest rates substantially. And that's what's happening, not just in the US, but around the world. All these central banks are starting to rewind and take back some of the stimulus they gave. The other lever they can pull is the money supply, and that's exactly what they're doing right now. They're looking to take that money out of the system. We previously went through the process of quantitative easing. Let's go through the steps where the central bank unwinds this activity to where we go back to a normal money supply. The first thing is the government has to stop selling these additional bonds and the central bank must stop buying those bonds. Now that started happening in March of 2022 in the United States, and most central banks around the world have stopped selling these bonds and started to think about or talk about or actually doing it and reducing their money supply. During this period of time, though, those bonds are still outstanding. And so the federal government has to keep paying interest. And that interest goes to the central bank. Because the central bank is no longer buying more bonds, that money coming in is actually reducing the money supply. Remember, they created money out of thin air and just created it into a note. They bring in actual money that pays back that deficit. So these interest payments are going to be bringing down the money supply. And then at a certain point, these bonds are going to mature, and they call this roll off. They're going to roll off. What happens is when the bonds mature, the government pays the central bank back the amount that they lent in the first place, further reducing their balance sheet. So basically, it's an unwinding of the process where the government then gives back all the money that the central bank lent it years before. That is quantitative tightening in a nutshell, and there's going to be some real effects to what happens in the economy and in the markets when this keeps happening. Okay, I wanted to take a pause right here and really talk about what we've been through. We have to go back to where we were in March of 2020. We had two choices as a country, the government, the central banks, we had two choices of what we could do. We could do nothing. And if we did nothing, then all of the studies and indications show that we would have had a terrible economy. We would have had job losses that this country has never seen before. And they talked about possible 25 to 30% unemployment. Some of the things I heard were 50% of all restaurants going out of business. This was a really dire projection. So if we did nothing, that's what would have happened, likely. And maybe it wouldn't have lasted too long. Maybe we had 6 months of real pain, and then we could start to build the process back up. And maybe by 2022, 2023, the economy's back on track. Or we could have done what we did, is where we stepped in and said, okay, let's do everything we can. Let's just fire the shotgun and do everything we possibly can. Fully knowing that inflation's down the road. It always leads to inflation. We called this in May of 2020 when they started doing the stimulus. They said, look, the only place this can go is inflation. So now inflation's here, and it's a problem. It's a big problem. It's hurting a lot of people. But looking at the whole situation, this is my personal opinion here. The Fed did the right thing. The governments did the right thing. The price to pay for that is inflation. And it's here, and it stings and it hurts. But I think if you look at the alternatives to what could have happened versus this really painful inflation right now, I would absolutely take the painful inflation. Again, this is my opinion on the thing. That money has to come from somewhere. Just like it had to go somewhere, it has to come from somewhere. So let's take a look at home prices first. So this is the Case-Shiller Home Price Index. And you can see that, as of COVID, we ramped up significantly. So if we take a look at this blue line, you can see that house prices in America appreciate, 4% a year. And that's pretty much true for around the world, about 4% a year. And so over the last 2 years, the Case-Shiller Home Price Index is up in the low 30% area. If this was a normal market and COVID never happened and we never got the stimulus, you would assume that home prices in the US would have gone up 4 to 5% a year. And you could even say, hey, you know what? The home prices go up faster in a good economy. Okay, so you might even say 5, 6, 7% a year might be reasonable. That gets you roughly to about 12 or 13%. 14% maybe that should have happened. Instead, we're up 33. Is there still some air in housing? And yeah, the answer is yes. If we take a look at the United States home ownership rate, if we go all the way back into the 90s, you can see that we're pretty much in the middle of the road. Peaked out here in March of 2005, 69%, bottomed out over here at 62%. You can see we're right in the middle. Now, housing is a pretty interesting one to talk about because, yes, we know that the prices have appreciated much faster than normal. We believe in reversion to the mean. It always happens eventually. Sometimes not on your timetable. We are going to see reversion to the mean. Either prices have to come down or they have to go sideways for a number of years until the average catches up to it. In housing, prices are high. Affordability is low. The problem is we chronically underbuilt houses in the United States over the last decade. When you look at this on the supply and demand, yes, housing's too hot. Yes, it's not affordable. Yes, it's likely to come down. But I don't see a big chunk of money coming out of housing. And we're also moving into higher interest rates, which means that there are a lot of people that are going to be trapped in their house. And what I mean by that is that when you have a mortgage at 2 3/4% and you want to sell your house and move to another city, the new house, you have to buy it at 5.5%, 6% interest. The same house, the same price house will cost you probably $1,200 to $1,300 more a month. So people just won't be able to move. One of the big problems with real estate right now is the low inventory. And I don't see that changing. So I do think real estate has probably seen its peaks, but we're probably going to not see a big crash like we did in 2007 and 2008. Let's move on to the financial markets. So let's just take a look at the S&P 500. Now what I want to do is I want to see, okay, where are we, where have we been, and where are we going? Now I'm looking at a weekly chart here. So that every one of these candles is a week. And you can see we topped out right here at the end of 2021 was the high. And since then, the S&P is down about 6.5%. That's a pretty big dip, especially when you take a look at the long-term appreciation of stocks is typically around 10% a year. And so this is definitely a down year. The question is, how much air is still in the stock market, in the S&P 500? And you can see we had a pretty big run here. We had a 113% run, and we've given back 6%. Okay, in a normal market situation with no COVID, with no stimulus, the question is, where would the market be if it didn't happen? So let's go back to where we were right here before COVID really hit. So 3390 on the S&P. And for 2 years, let's say we got 15%. We got 15% per year over these 2 years. The question is, where would the market be if that was the return? And then how much of a difference is it between where it is today? So if we run these numbers, 15% a year, that gets us to somewhere around 4480 on the S&P. And if you can see here on April 21st, we're actually below that point. I think when you take a look at the S&P, you can say to yourself, I'm not saying that the stock market is cheap here, but is there a lot of froth in S&P type stocks? Again, these are just bread and butter, boring companies. The answer is not really. There's not a lot of fluff in them. So let's take a look at something like the NASDAQ. If we take a look at the NASDAQ composite, we topped out in November. And since then, the NASDAQ is down about 13.7%. So that's a bad loss. So again, it's already popped. We've seen the market give back some of its gains. However, if we go back and say, okay, let's do the same thing we did with the S&P. Let's take where we were before COVID and say 15% a year. Where would we be? That calculation brings us somewhere in this 12,000 area. So right now we're at 13.2, 12,000. Again, this is if you assume that the market went up 15% over the last 2 years. Now, there's no guarantee that would have happened, but in a normal market, and I'm giving it an extra 5% a year. The average market return is 10%. I'm bumping it up 5 to see, okay, how much extra capital is there? So we've got roughly about 10% more to go until this NASDAQ gets down. So we looked at housing. Housing looks overpriced, may not come down all that much. The S&P looks fairly priced, in my opinion. The NASDAQ still looks overvalued, still looks substantially overvalued. Let's dive into some other things. I'm going to take a look at the Cathie Wood's ARK Innovation ETF. Now, this was one of the hottest things to come around. And if we go back, the high on this thing was 150, 155-ish. And you can see we're down to 53. That is like a 66% loss. That is a nasty, nasty loss. The question is, where was it? We come all the way back down here, and you can see that the Cathie Wood's innovation stocks have lost all of their bubble. That doesn't mean it can't go lower, and I think it is going to go lower because, again, these are the most speculative companies. And when the market was rewarding those companies, her fund did great. When it turned around and said no more, her fund did not do so well. A lot of the air has already been let out of this. So if we take a look and say, okay, housing is a little bit overvalued, S&P looks okay, NASDAQ still overvalued. As you can see, there's still some froth in equities, and specifically in the high growth names. We're trying to identify where is the froth. So there's no doubt that there is still some froth in tech, and we think tech is likely to move lower because of it. Let's jump over to the cryptos. Let's take a look first at Bitcoin. So Bitcoin today here is at 41,000 and it topped out here at 67,000. So you take a look at that and you say, oh my gosh, that's 25,000 points. That is about a 40% drop from its high. That's a steep drop. The question is, where was it back before COVID? And you can see if we do the same thing, we are basically right, let's just call it 10,000. This is where it's going to get difficult. And I know I'm already going to have a couple people that disagree with me on what Bitcoin's yearly rate of return is. Look, it's so new and it's been so explosive. The average Bitcoin return is probably substantially higher than the market. With that being said, I just want to talk reasonable rates. So let's even say that Bitcoin, let's say it went up 30% a year. That is a lot for an asset to go up. Let's go 30% a year. 30% return per year brings us up to right around 17,000. 17,000. As you can see, we are a mile away from that number. Look, I am not calling for Bitcoin to go to 17,000. I actually don't think it is going to go there. But when we're taking a look at, okay, what's a normal rate of return? And what is the rate of return that we received because of all the stimulus? You got to take a look and say, wow, this probably is one of the more risky places to be. There's a lot of money that could come out of these. Let's take a look at Ethereum. Ethereum was at 270. So let's even give Ethereum a little bit of a bonus and say, hey, we think Ethereum should have made a 50% return every year. Let's see what those numbers are. With a 50% return per year, that would have brought Ethereum to 607. So we're somewhere right around this area. We're at 3,000. There's a lot of air still in these things, and they definitely could come down. When the quantitative easing starts, the question is, the money has to come from somewhere. Where's it going to be? It's not going to come out of people's wages. It's not going to come out of Walmart. It's going to come out of the speculative assets. And there is definitely a lot of froth left in crypto. So when you're out there looking, saying, okay, where is quantitative tightening going to hurt? I think you just have to look at reversion to the mean. What had much larger runs than normal? That's likely where we're going to see the money come out. Thanks for joining me in this video. Hope you enjoyed it. If you want to check out what we said at the first of the year, I'm going to put a link here to our year in review that we do every single year. We did it in the first 2 weeks of January of 2022. And we basically gave our projections for what we thought was likely going to happen. And pretty much what we projected has been happening. We called for tech stocks to take a real serious dive and be down possibly close to 20% some point during the year. But we did call for the S&P to be down 5% or near the break-even point. So go ahead and click on that and check it out. And it's always fun to make these projections. What we did not project was any sort of war. That was a big surprise, and that has really just ramped up all the issues. Thanks for joining us. Bye.